Well, it is finally the end of the week. It was a week marred by geopolitical tensions after Hamas militants attacked Israel, sparking retaliations across the globe. The conflict kept markets on edge across the world. Crude oil prices saw some wild swings. The sensex and the nifty, though, posted marginal gains for the second week running after some choppy trade intraday. Amidst all this, the earnings season has also begun, and the top IT companies are yet to see blue skies. Hello and welcome to Editor's Roundtable. Today we discuss geopolitics, take stock of the earnings season and preview what's to come. We also discuss the sharp rise in SIPs fueling the markets recently. I'm Sonia, and with me, joining me on the show today, there's Nimesh, Reema and Nigel. Folks, very interesting week, very unfortunate as well what happened across the globe, and of course the escalation continues now. But give and take everything, this was not a bad outcome considering that the market recovered, the dips were bought, and by the end of the week we ended in the green.
Absolutely, up 0.5%.
It's not a bad week, it's a good week. I mean, we've seen everything what we can, from a global perspective, geopolitical perspective, and still market has been so resilient. And I guess one of the reason is what Nigel will put out in his piece, the domestic money. I mean, $2 billion of SIP money coming in. That's what is actually driving the Indian markets, at least in this first half of this year.
Yeah, I think if someone told you at the start of the week that there's going to be a war that will break out.
And crude prices are at 88, a big jump in crude prices.
And you'll end the week in the green. I mean, with all the IT disappointments.
But Nigel, if you look at past history as well, war-led sell-offs has actually been a big buying opportunity. So in that sense, and also the fact that with this war, we've not seen a big reaction to crude, we've not seen a big reaction to the global, political this thing has just been with the one region, right? The risk now is if it gets extended and spread to other continents in Middle East, that will be a big risk because then your oil can really spike up. So till then, I guess it's basically for us from an equity market point of view. I think we'll just take it in the stride and brush off.
There's just one factor that was worrying. The broader market strength is what we've been talking about, but some of these low float companies, which are spiking up 30% in a single week, that's a bit of a worry, because some of them have only 2 or 5% in the market, or 7%.
That's liquidity, no? That's the liquidity. So much of domestic liquidity is there in the system. And while we talk about the SIP money and all, one should not forget the fact that there is a structural domestic money which is now flowing to the markets, right? Not only the SIP money, but the EPFO money as well, and the fact that even the retail money has been so powerful these days. They've all tested so much of success in the last 2 years that they are just hungry to buy new stocks. So I guess that's what is explaining a big move in the broader market.
Absolutely. So we'll just take stock of what happened in the week and then we'll talk about what the dealing room said. It was the second straight week of gains for the sensex and the nifty. Given all the bad news, given all the global turmoil, the sensex and the nifty gained 0.5%, which was not bad, while the nifty bank actually slipped for the fourth straight week, so there's a bit of underperformance over there. The mid-cap index also saw gains of around 0.5%. Now, IT sector was under pressure. TCS said that the demand situation has not recovered. Infosys slipped 2% after the company cut the upper end of their guidance despite a strong Q2. HCL Tech was the only one that rose about 3% on Friday after the company expects the second half to be stronger than the first half. But next week is important because we dive into earnings season with a lot of heavyweights coming out with numbers. There's HDFC Bank, there's ICICI Bank, there's HUL that comes out with numbers as well. So all eyes will be on that. But Nimesh, the interesting part, and I'm sure you got that outlook from the dealing rooms as well, is that this is a buy on dips market through and through, despite all the bad news that has come in.
Oh, absolutely. So I know, and you've been saying this for the last many days on your opening chat as well. And again, this is a week when we've ignored all the global cues, not only the war-related concerns, but the fact that our dollar index is back to where it is, 1.6.5. Your 10-year has moved back to 4.7, and still market has been resilient, and India is actually outperforming. And I got a very interesting feedback this week. I met a couple of large investors, people who just came back from overseas trips, whether it's Europe and the US. The fact is, India is now actually been looked upon by a lot of emerging market funds to increase the India exposure. Remember, FIs have net sold in the last 2 years. Even this year, they've been net sellers. So India is not overexposed by the FI. So that is a big cushion from an India perspective, because if once they come and buy, and they'll buy large, we'll see a further rally. So the good part is the FIs are underrun at this point in time. The other interesting feedback that I got is now India has been looked as not only the large 5 stocks like HDFC banks of the world or the ICICI banks of the world. People are now looking at which are the big sectors which will drive, and then looking for large cap names. Even the overall market cap of India has gone up, right? There are so many large market cap companies now which global investors can bet on. So I think that's clearly standing out from an FI perspective. So that's an interesting feedback that I picked up this week. From an earnings point of view, I think this week was relatively disappointing. Rima will explain about the IT names. The numbers were not disappointing, but the reaction was disappointing because people were hoping for a bit of a outperformance in the IT names. So that came as a bit of a negative surprise. But again, the big outperformer for this year has been the PSU stocks. Nigel explained about some low float stocks moving up, but the overall momentum is so strong. And I've been saying this, just look at some of the annual reports of PSU companies. They've dramatically changed in the last few years. So there is clear focus from the government. There are top guys who are now heading these PSUs, and that's clearly showing up in the stock price reactions as well.
Okay, by the way, we have Ajay Srivastava joining in, CEO of Dimensions Corporate Financial Services. Ajay, all roads lead to Ahmedabad this weekend. Are you heading there as well?
No, I'm not heading there. It's a given. We are going to win. What's going to see the match? I think it's a given. We have to win. That's it. And in Ahmedabad,
it's not about watching the match. It's about experiencing the whole thing live, right? I mean, I guess that's what matters.
I don't have to say the North Indians enjoy the match only one way, and that's not possible in Ahmedabad.
I love it.
Okay. Well, I will have to take that sort of off camera, that discussion. But how are you feeling about the market? Because, like Nimesh, Rima, all of them were saying that this was a week where a lot of bad news was thrown at us, whether it was geopolitics, whether it was weak IT earnings. Despite that, we've been quite resilient. So you think we're, moving northwards now?
I think we should name all your editors punters more than editors now. I think they are really... They should be in the punting game. They are, if you look at I love the fact that everybody's body language says buy and buy and buy, and nobody's telling the customer, gentlemen, there is a thing called earnings and there is a thing called valuations. And I think that's an important perspective. Yes, there are tremendous flows. There is no doubt about it. But honestly, the market is overpriced by a fair degree in most stocks. And one of the reasons, we may say FIs are selling or not selling, they're underinvested. But the fact remains that the investors, which is both PE funds as well as the FIs, are selling out. If you see, the maximum sales of PE fund has happened in this current year. So while, yes, one cannot argue against the surge of liquidity, the fact remains it's a very expensive market, and you've got to be very sure of why you're holding the shares. Some themes continue, capital goods and those kind of themes continue. But by and large, this is a market which is built on high expectations. And the reaction that you see for IT, for instance, I would still say was muted. It could have been worse at this point of time, is based upon the fact too much expectations, too little profits on the ground. And well, as they say, you can't argue against the market, but the fact is we are in a very overpriced market, and you've got to be very sure what you're doing here.
All right, Ajay, you made a couple of points, so let's take that forward. Then you spoke about earnings, so we're going to be taking note of earnings as well as IT. Rima's going across to the big ball to give us a complete wrap of what we saw this week. Rima.
Well, the last 3 days were all about IT, so I thought it would be nice to just give a complete snapshot of what the IT earnings were in 10 quick charts. Right? So the first one is Q2 revenues. Now, Q2 revenues were largely muted, a continuation of the weak demand over the last 2 quarters. There is no big deterioration, but there isn't big improvement. In fact, TCS and HCL Tech both disappointed the street on the top line. The second one is on margins. Now, all the 3 IT companies, TCS, Infosys, HCL Tech, positively surprised the street on the margin front. Now, this was led by better employee pyramid. It was led by better utilization, a headcount reduction, perhaps some cut in discretionary spending. Infosys has embarked on a Project Maximus, a cost optimization plan. So the margin performance in Q2 looked very good. But the key highlight, and that's the third plate, are the deal wins. Record high deal wins coming in from Infosys, HCL Tech. For TCS, it's the second highest on record. And just compare the current quarter's deal wins versus the average over the last 12 quarters. The only thing is that these deals are largely long tenure in nature. Yet, the IT index closed with a cut of 1.5% to 2%, and that's because the outlook for this year continues to be very weak. IT companies are likely to grow in low single digits. Infosys lowered its revenue guidance for the second consecutive quarter. They started the year saying that we're going to grow at 4 to 7%. Then they brought it down to 1 to 3.5%. And this quarter, they further lowered the top end of the guidance, and now it stands at 1 to 2.5%. HCL Tech too started the year saying that we're going to grow at 6 to 8%. But now they're saying, well, including the acquisition that we've done, we're going to grow at 5 to 6%. The margin guidance for FY24 has been maintained, both by Infi and HCL Tech. One of the other notable trends we've been seeing is the sharp reduction in the headcount. Demand is moderated, and so is the employee requirement. And plus, over the last 2 years, companies did overhire compared to the demand requirement right now. This is the headcount reduction seen in the current quarter. Attrition too has fallen off, and fallen off quite sharply. In fact, attrition now for all these companies is back to what it was on a pre-COVID levels. So if you remember, over the last 2 or 3 quarters, attrition levels had crossed 20%. Now it's back to that 14-15% band for the IT companies. So sharp drop-off from the peak levels. Now, what's the sum and substance of all this, right? What is the analyst community made of it? Well, they've lowered the growth forecast because of the miss in Q1 and Q2 and the fact that growth expectations have pushed forward. Yet again, the street was hoping that in H2 we will see a pickup in growth, but that's not really materialized from the body language of Infosys and TCS. So right now, the street has lowered the full year growth forecast. What they've done, they're now saying is that in FY25, we are going to see a big pickup in growth. So growth rebound will take place only in FY25, not in FY24. And finally, let me bring you how the stocks have performed. In the last 3 months, the stocks have outperformed. In fact, on an average, the Nifty IT index is up 7% in the last 3 months versus the Nifty which is up 1.5%. Now, this was driven by 2 factors: the strong deal wins that we've seen in the last 3 months, and 2 expectations of a growth pickup. Now, that growth recovery expectation has been pushed forward by at least 2 quarters. Growth recovery is likely to take place only in FY25. So now the big question is that as growth visibility is quite muted for the next 2 quarters, is it time to bet on the IT sector? Ajay, where do you stand on IT right now?
You know, I stand and say very simply, it's one of the best sectors for Indian investors. And I'm not sure your analysis includes the dividends and the buyback benefit that come to that. Maybe it does. I don't think it does, but perhaps it does. But it still remains that if you're in the Indian market and you want to have a safe investment in the market, leave aside the mid cap, the large cap story, this is the place to be, because for anybody who's retired, anybody's regular income, anybody who wants money to come back, these are fantastic cash generating companies. Yes, the share price performance has been relatively muted over the last 3-4 years, but there still remains that they are returning back tons of dividend. They are returning back buybacks quarter to quarter, you know, and you have got safety of investment. And the best part, rupee is your friend because it is depreciating year on year. It was 72 not long back. It's 83, 84 now. It's going to be 90, 95 or 100 in the next 5 years. So you are in a business which is naturally gaining traction in a good governance environment. You can't get away by not using IT companies. Yes, the volume may go up and down, but that's the reality. And the best part, they are not at ransom from their employees today. For the first time, they are in a position to command and say, we want you. The sad part is, I do not know what's going to happen to the engineering graduates who are going to come out of the colleges, because as I understand, they are not going there. So for investors, I think the great companies, the leverage against people is there right now. I think the margins will go up further if you ask me personally, Rima. But the fact remains, I'm so sad for the people who are passing out. It's a sad day because knowing that these companies won't come, they should pick up the bulk of the people. So it's happiness on one side. For investors, it's a surefire do it, but very sad for the people who are expecting the employment in these companies.
Okay, take that point. Jay, just stay with us. Nimesh, talking about earnings, there will be some surprises. Run us through the list.
So Nigel, again, last week I put out a piece on overall what to expect in the Q2 earnings. Today I've looked at the individual names which can surprise both on the positive on the negative side. So I'm quoting the Citi report. Citi has put out the Q2 earnings preview, and in that they've mentioned about few stocks which can surprise positively and negatively. I'll start with the positive list first. According to the Citi note, the one big positive surprise in the earnings could come from Maruti. They believe it will report healthy margin expansion due to the improving mix. So that is the first stock for them. Nestle could be the second stock to watch out for. They expect Nestle to outperform all the peers in terms of revenue growth in Q2. The third is Shriram Finance. Now, strong AUM growth is what Citi is expecting, backed by contained NIM contraction and stable asset quality for Shriram Finance. So that's the third stock to watch out on the upside. And the fourth one is L&T. They expect very strong core order book inflow as well as revenue to surprise on the upside in this quarter. So these are a few names which can surprise positively. Also, watch out for names which can surprise negatively in the Q2 earnings. That includes names like Tata Steel, widening of EBITDA losses in Europe. That's the first thing. Second, Star Health, the combined ratio can surprise on the downside. So watch out for that number. Bata could be another interesting stock to watch out for. A lot of people are expecting, but Citi expects that the revenue may disappoint in Q2 for Bata India. And the fourth stock is Zydus Life. There they believe that the weakness in the India business as well as Revlimid, generic Revlimid can result as a negative surprise as far as Zydus is concerned. So these are the few stocks individually where Citi expects positive as well as negative reactions in the Q2 earnings.
Okay, thanks a lot for that. Well, Ajay, I just want to get you in on this very quickly because, you know, for a company like Maruti, a lot of things are improving, right? But the stock has also seen a decent performance. Do you think the risk reward is still in favor of an investor now at this price?
Of course it is. Of course it is. You know, they are going to treble the capacity at this point of time, which is in a 3 years time frame. I think that's unmatched in the whole auto segment, and sooner or later they come into the EV market, which they've been absent from to the large extent. I think that's going to be the big filler. Maruti is a very good company. It's steady. It's lost its way in terms of SUVs, come back, new capacities. Engine plant is now coming back into the company, which is a great positive, and coming back at a book value, as I understand. So, you know, so somebody spent money for 3 years, put up a plant, but given it to this company at book value. So the promoter has done a great favor. All in all, I think you have a very safe wicket. How do you find a good auto company with 40,000 crores in the bank, sensible management, good quality products all over the country? You can't beat that thing. That's the titan of autos, if you ask me.
Okay, all right. Well, let's do one thing. Let's take a short commercial break. We haven't done that in a bit. On the other side, the big headline, right? SIPs in India, record highs, big moves over there. The equity cult is back in a huge way. So we'll talk more about that on the other side of the break. Do stay tuned in.